Hello, everyone, and welcome to our very first Taking Stock recording for 2024. I'm Tim Lincoln, and joining me today is Kien Trinh, our head of Stock Doctor Research, to stream you all things share market. And I do hope that 2024 is off to a terrific start for you and your families. And welcome, Kien, and is 2024 off to a great start for you?
Yes, it has, Tim. But time has certainly flown, and it's also been a great start for the market as well, Tim. And we can't keep our eyes off the market still. We continue to monitor, even though some of us have had a good break during the last month.
Yeah, well, more on that roaring market in a moment, Kien, that I believe is getting way ahead of itself. But anyway, more on that in a moment. But before we get started, just a quick reminder to everyone that all of the information we share is of a general nature and therefore should not be construed as personal advice. And all of the data and performance metrics that we also share, all historical, so therefore shouldn't be relied upon as a guide for future performance. So as we touched on, Kien, the calendar year and the month of January is just following in the heels of November and December last year, whereby the market is just flying. And, the first half of January was looking really lumpy, a lot of profit taking and some nervousness about some macroeconomic stuff. But then in the second half of January, off it went again, both here and in the US, with the All Ords up 1.1% for the month of January, and the S&P 500 in the US up 1.6. So the bulls are certainly still stampeding.
Yeah, the market, it's rallied quite strongly after December, Tim, and it continues to be driven by lower than expected inflation data, which has dropped to an annual rate of 4.1% in Australia, raising the prospect that we'll have another 2 interest rate cuts by December this year. And market participants are clearly expecting a soft landing, both in the US and in the Australian economy, Tim. But as highlighted in our Stockroom episode earlier this week, we cannot be too complacent, given that there are earnings risks on the horizon. And the chart on screen here shows the trend in earnings expectations for each financial year period. As you can see, earnings forecasts for this financial year, and that's in light blue, and in financial year 25, that's in yellow, have been trending lower over the last few months. And even in the US, although the earnings trend appears to be positive, as you can see, it's actually the forward estimates have been masked by the profits from the largest 7 companies, such as those from Alphabet, from Apple, Amazon, Microsoft, Meta, and Nvidia. If you look outside this group, though, earnings expectations have been trending lower, as you can see from the chart by FactSet.
Yeah, and in line with falling earnings expectations, Kien, it's been a subpar 4-quarter reporting season so far in the US market. And currently only 69% of companies have met or bettered expectations, which is well below the five-year average of around 77%. So some warning signs there. And the irony here is that these figures have come after earnings have already been revised lower, which is really interesting. And that's what that last chart was highlighting. And therefore there's a massive disconnect, Kien, between corporate fundamentals and actual share market performances. The impact of interest rates hikes from last year continue to feed into the economy, while consumer savings that were built up during COVID have all but dried up now. And in the words of Warren Buffett, we need to be fearful when others are greedy, and the market's reeking of that at the moment. Hence why risk management is critical at this point in time. Not only should investors stick with financially healthy businesses, but you should also be really proactive with the management of your portfolio, really proactive, especially as we enter reporting season here in Australia. For example, it would be really, really prudent right now to trim some profits off some of those stocks that have just rallied so strongly. Great quality business that have done really, really well. No, those stocks include Helia Group. Just have a look at their stock price. Pro Medicus, what a story. And Super Retail, defying retail spending figures. So, some real quality businesses there that have just shot the lights out. and ideally then use these proceeds to look for opportunities that perhaps haven't rallied as much, high quality businesses that haven't rallied as much, especially as volatility continues to possibly emerge. But more on opportunities later in question of the week.
Yes, Tim, the share market doesn't seem to be factoring those risks, especially at the consumer level. For example, we looked at retail sales, which is usually strong during the Christmas period, but that was down 2.7% in December and below market expectations. This figure comes in stark contrast to many retail stocks, which have rallied strongly over the last few months, Tim. In fact, if you look at the US reporting season, and if you see that as a guide, the consumer discretionary sector has been the weakest performing sector when it comes to meeting profit expectations.
Yeah, amazing, Kien. And weaknesses across consumer sentiment may ultimately feed into corporate profitability. We've got to be very mindful of that. Hence, this is the season, this is the reason why we continue to hold a hedge position within our managed funds here in Australia. The threat of an economic recession remains viable, and if this plays out, it is likely to lead to further earnings downgrades. For more details on my current thoughts and tactical position in our funds, please refer to my quarterly message that was distributed to Stock Doctor members a couple of weeks ago. And that's available either on the Stock Doctor homepage or within the Resource Centre. So now, Kien, let's switch our thoughts onto some stock highlights. And you can often tell when reporting season is about to kick off because Credit Corp is among the first to report. And Credit Corp, being an ex-Star stock, it's involved in debt collections and unsecured consumer lending. And Credit Corp itself has rallied hard into its first half 24 result, almost recovering most of the capital loss since the announcement that it was writing down 14% of their US debt book value. The result appeared in line with the company confirming its guidance outlook for financial year 24. All that considered, Kien, what are your thoughts?
Yeah, Tim, we had a close look at this one as well. And behind the headline numbers, though, we see that default rates are still on the rise, suggesting that many people are unable to pay their debts, making it harder for Credit Corp to recoup those bad debts. Also, we're not entirely comfortable with Credit Corp's exposure to that unsecured consumer lending market, which represents a third of its earnings. Hence, we want to remain on the sidelines for now.
Yeah, fair enough too. And risks are still quite elevated with Credit Corp too, Kien. But let's turn our attention to a stock where the risk appears to be subsiding, and that's sleeping disorder specialist ResMed. What a company. The business was previously impacted by concerns of the emergence of new weight loss drug, GLP-1, which may lead to less people using its obstructive sleep apnea devices. Any further detail on that, Kien? Has that risk subsided?
Tim, fortunately, in this case, common sense has returned, and ResMed's share price is recovering after world data suggests that such weight loss drugs have no negative impact on the number of CPAP patients initiating therapy. Positively, management guidance is for ongoing margin recovery, which should support its return on equity at around 24%, Tim.
And notwithstanding, Kien, competitor Philips is still experiencing headwinds after the US Department of Justice prohibited the company from selling sleep and respiratory devices in the US due to faulty product and recalls. This prolongs ResMed's opportunity to take market share in the US. And Kien, it's really important now that we focus on the corporate calendar because it is reporting season. It's often running here in Australia. So who do we need to be mindful of reporting next week?
Tim, there's next week, there's going to be a few REITs expected to report, but within our Star Stock universe, we've got BWP Trust and also Charter Hall Long WALE REIT. So that's one to look out for, especially after that acquisition that BWP Trust did. Also, Suncorp, the insurer, they are expected to report their numbers as well. And they released an update not too long ago talking about the claims, especially with all that flooding in the East Coast at the moment.
So as things really heat up during reporting season, we'll showcase those companies reporting each week in taking stock. And also really important for yourselves to keep your eye on the corporate calendar for stocks that you're interested in, whether they be in your portfolio or watch list or whatever, as they report, because timing and the timeliness of information right now is really important from a portfolio management perspective. And now to Under the Microscope, Kien. And this week we take a look at some star stocks in the resources sector following their quarterly updates. And lithium prices have been absolutely belted, especially over the last year, down some 80% plus. And prices have fallen on the back of slowing growth in the global sale of electric vehicles. Let's first take a look at IGO, Kien, and in particular, they've come under immense pressure in regard to their share price. Is there a fundamental reason for this, or is it purely on the back of declining lithium prices?
Yeah, Tim, if you look at IGO, it's not just lithium prices. You remember they did a 1 billion acquisition of Western Areas nickel assets, and due to plummeting nickel prices, they've had to just put the operations on hold and put them into care and maintenance. And furthermore, they had a minority position in the joint venture lithium business, Greenbushes, and that's resulted in a cut to production and sales. And of course, this has led to the negative growth outlook for the stock and contributed to the negative earnings revisions.
Well, it's fascinating, isn't it? So they've double whack there for poor old IGO with lithium and nickel prices. But does the weakness in this space, and especially the underlying commodity prices, represent an opportunity for investors, Kien?
Yeah, Tim, Dan has articulated the risks in the short term, but views the lithium industry as an attractive long-term thematic. In particular, though, he does favour the quality balance sheet and asset control of Pilbara Minerals, as well as the diversification benefits of mineral resources, which are his key picks at the moment. Arcadium Lithium recently formed from the merger of Alchem and also Livent, and also IGO. They're still good businesses, and they could represent opportunity, but just over the coming months, there are a few overhangs in the short term, which are articulated in the strategic comments. Yep.
So with it was good to see both of those stocks, Kien, that we mentioned have a positive reaction on the day, Kien. One report which stood out to me was Gold Resources. The company has announced a downgrade to expectations for calendar year 24. What's your view on Gold Resources right now?
Yeah, this gold miner, Tim, the downgrade was driven by higher costs, and that was due to increasing wastes that must be removed to release the gold. And in technical terms, this is referred to as the strip ratio, but Dan believes that the share price is fairly valued at these prices, although we just got to keep in mind that earnings and the share price will continue to be dictated by gold price movements. And following on from our analyst star stock ideas mentioned in our last Taking Stock episode at the end of last year, and also reiterated in our Stockroom webinar earlier this week, now it's your turn, Tim. What are some of your top stock ideas for 2024?
Yeah, look, Ian, I'm really excited to share these, but I think I just need to position a couple of things first, which are really important. So firstly, due to my deep concerns about the unsustainability of the current market's insatiable desire to run and run hard against significant headwinds, I believe it's my fiduciary responsibility to protect our investor funds in our managed fund products against what I believe to be a high probability of some sort of correction at some stage in the not too distant future, only because I believe that, the market is now fully priced in a really soft landing. And we don't think that landing is going to be quite as pure as what the market is priced in. So really important that we do that. And as mentioned earlier, I've got a 30% position within our portfolio allocated to hedging instruments that protects our portfolios 100% from downside risk and volatility. Secondly, I still have to try to maximize the performance of the remaining 70% of the portfolio that's allocated to stocks. And I see wonderful opportunities at the moment, as it really has been only the very large caps driving markets north. And I see that mainly due to the sheer weight of money, of passive money, from passive funds flows, in which I see a potential massive risk and potential bubble forming. And please read once again my quarterly message that elaborates on these risks and concerns further. And there's more to come on this passive money flow subject in the next couple of weeks also, that'll be available to all members. And therefore, there are still some great bargains in high quality businesses still to be found. So the stocks I mentioned, I'm considering from a real value and contrarian perspective. So let's get started, Kien. Thanks for that little moment where I really felt it important to position things. Let's start from an income perspective. I really like salary packaging and evaded leasing company, McMillan Shakespeare. The share price has been under pressure after it generated a lower yield than expected from electronic vehicle sales, as well as a loss of contracts from the South Australian government. The stock has triggered an exit on SD30 TSR, but I view this stock as, from again, a contrarian growth perspective, and also a good yield opportunity too right now.
Yeah, it's certainly well below its highs, Tim, and because of that, there is an attractive gross dividend yield of around 10%, and it's expected to go ex-dividend pretty soon on the 3rd of March as well.
Yeah. And staying on the income theme, Kien, another income stock that I really like at the moment is APA Group. Share price has been belted and weighed down by the acquisition of Alinta, which was funded by debt. In addition, the higher cost of debt has also impacted earnings estimates, and with revisions going lower. But despite the decline in operating cash flow this year, there is still sufficient margin above dividend expectations of 56 cents per share for this year. So really excited by the opportunity, both from a potential share price appreciation perspective and a really solid yield that can only become more attractive if investors get in nice and early.
Yeah, definitely. In this day and age, especially with economic conditions deteriorating, Tim, utilities where earnings should continue to be resistant. And also, it's got a gross dividend yield of about 7%, looking quite attractive, even though it's partially franked and not expected to go ex-dividend until late June. So plenty of time for investors to jump in. And also, Tim, what about income opportunities outside of our star stocks?
Yeah, that's where our growth and income filters with potential, all within the stock filter, can play a really valuable role to try to find some little hidden opportunities. So within the income filter with potential, we found refrigerated transport business, Lindsay Australia, with the ticker code of LAU. And it stands out as an opportunity, a really strong opportunity for yield. Early in 2023, the company benefited from the collapse of a key competitor, Scott's Refrigerated Logistics. This has allowed the business to take market share and become more profitable. This structured change should help the business sustain its dividend with a grossed up yield that includes franking credits of some 7.3%.
Yeah, Lindsay Australia is certainly an interesting stock at the moment, Tim, and it's expected to go ex-dividend at the end of March. And now within the star growth stock space, what stocks do you think have great potential this year?
Yeah, from that contrarian perspective again, Kien, I can't take my eye off that lithium price at the moment, just how it's been belted. So I'm really backing Dan Ortiz's call with his preferred lithium stocks being Pilbara Minerals and Mineral Resources, which are now well below their share price highs as well. Pilbara is a high quality asset with an excellent balance sheet, which should support its financial health going forward. Meanwhile, Mineral Resources is a founder-led business with serious skin in the game, which our members know I love to see. under Golden Rule 7, and an iron ore development, which should diversify its earnings and reduce its overall costs. Among our star stocks also, from a growth perspective, I love ResMed and the opportunity that's presented with it. Still, its share price is well below its highs as well. And especially following their latest results, the company continues to gain market share on rival Philips, as we touched on earlier. Plus, the obesity risks regarding weight loss drugs have been overplayed by the market, which led to the volatility and hence the subsequent opportunity that I believe exists in this high quality business right now.
Yeah, no, certainly ResMed looks like an opportunity there. And what about outside of our star stock universe? Any growth opportunities there?
Yeah, again, just scouring, Kien. You know, these stocks have got to meet our financial health criteria. Of course, they've got to be healthy, and ideally, they've been smashed down because of reasons within their sector or the overall market. So hopefully, picking up opportunities from contrarian perspective. And one stock that really is popping out to me at the moment, an ex-star stock, was a star stock there quite a few times in and out over the years, is the travel booking business Webjet, online travel bookings, which is expected to generate return on equity of over 13% this year. Growth has been driven by its B2B arm, where it sources guests from independent hotels. There's also less competitive pressures, given that many travel agency businesses collapsed during COVID. So their prices were belted down during COVID. Now we're seeing that traffic return and obviously subsequent recovery at a time when share prices are still quite suppressed. Lastly, I think, now this isn't from a contrarian perspective, because share prices already run pretty hard on this business, but these are the sort of little opportunities we love to look for. Neuren Pharmaceuticals, stock code NEU, has potential with its ROE at 88%. The business develops drugs to treat cognitive disorder, Phelan and McDermott syndrome in children, e.g. delayed speech and development. It's also touching on drugs and assistance for autism spectrum disorder as well. So very, very interesting, cutting edge stuff, but that's not without its risks at the same time, Kien.
Yeah, definitely, Tim. As you mentioned, the share price has rallied quite strongly after it announced the success with its phase 2 trials. And the other thing with the company is that it also receives royalty payments from US sales of what they call Day Blue, which is a drug for Rett syndrome as well.
Yeah, that's right. And but the risks are there with high risk investment with no analyst coverage. We can see that under Golden Rule 3, and share price will be volatile as it conducts its stage 3 trials and it's all about FDA approval for this type of company.
Yeah, that's right, Tim. And these opportunities and more can be found under your Tim's growth or income filters with potential. So make sure you take a look or run your own screens here.
Yeah. So I hope those tips are useful. Really good case studies, but you know, all real quality businesses. That's what we love, and it's awesome to see in this environment that there still are opportunities with really the big end of town just driving markets north. Well, Kien, that's all we've got time for today. We're also planning to run some masterclass sessions very, very soon, Kien. So more on that shortly, and you're really driving the planning behind masterclass. So looking forward to hearing more on that soon too.
Yeah, definitely. We haven't had one for quite a few years, Tim. So hopefully we'll be able to showcase some of our processes and the ways we implement strategies to build high quality portfolios.
Yeah, love the innovation in the business too, Kien, and more products and services to be rolled out to our members over the coming months as well. But in summary for today, the market, we believe, is overextended. It's really fully priced in a soft landing. We believe it's going to be a less than perfect soft landing, and that could lead to volatility, hence why I've got protection in our portfolios at the moment. But it is about identifying stocks that represent wonderful opportunities based on strong fundamentals that haven't quite recovered fully. and make sure you've got appropriate risk management strategies in place yourselves, and take profits on companies that have done really well, and diversify your portfolio across other asset class, across other companies and potential asset classes. And it is reporting season, so really important time to be super proactive with the management of your portfolios. Thanks a lot for tuning in. All the best for 2024. Great sitting down with you, Kien, as always. Take care and have a happy, healthy, and prosperous week.